You've probably heard it a million times. Foreign investment is the magic bullet for economic growth. But is that the whole story? Well, today we're digging into a fascinating working paper from March 2026 that really peels back the layers on what this investment truly means for a country.
And right from the executive summary, you can see this paper isn't pulling any punches. It's basically throwing down the gauntlet and directly challenging this idea that all foreign investment is automatically good. So let's explore that challenge and the evidence they bring to the table.
All right, first, let's start with a classic view, the one we all know. For decades, the story has been super simple. If you attract foreign capital, you're going to get new jobs, new technology, and faster growth. It's the big promise that has shaped economic policy all over the world.
Now, just to make sure we're all on the same page, this is the official definition of foreign direct investment, or FDI. That 10% voting power is the key part. It means a serious long-term stake, not just, buying a few stocks on a whim. At least, that's the theory. As we're about to see, the reality can be a whole lot messier.
Okay, this is where we get to the core of the paper's critique. It starts by revealing that a huge, and I mean huge chunk of what we call investment might not be what we think it is at all.
So you really got to understand the difference between these two. On one side, you have greenfield investment. Think of it as building something totally new from the ground up, a brand new factory, a new office, you name it. It creates something that didn't exist before. But on the other side, you have mergers and acquisitions, M&A. This is just one company buying another one that's already there. It's mostly just a change of ownership.
And check this out. According to UNCTAD, for the last 10 years, over 60% of all global FDI wasn't about building new stuff. It was about buying up existing stuff. Right away, that completely changes the picture of what all this money is actually doing.
But believe it or not, the story gets even weirder. The paper asks this really critical question. What if a massive pile of this money isn't for building new factories or for buying old ones? Then, what on earth is it for?
Get ready for this number, 40%. According to a landmark IMF working paper, this is the amount of global foreign investment that might not even be real.
That's right, 40% of global FDI is what economists are now calling phantom capital. It's money that just passes through empty corporate offices, these shell companies, usually in countries with super low taxes. It never builds anything, it never hires anyone, it contributes absolutely nothing to the real economy. It's basically a statistical illusion, all designed to avoid paying taxes.
Okay, so if a giant piece of FDI is basically a ghost, what about the rest? I mean, the real investment, that still drives growth, right? Well, this is where the paper wades into one of the oldest debates in all of economics.
It's the classic chicken or the egg problem. We see this all the time. Countries with high growth also have high FDI. It's a strong correlation. But which one causes which? Does the investment cause the growth, or do smart investors just see a country that's already taking off and decide to put their money there? It's a puzzle, and it makes it incredibly hard to prove cause and effect.
And this is where the paper's findings get really interesting. When researchers use some pretty advanced statistics to untangle this mess, that so-called growth effect from FDI, it shrinks dramatically. In fact, for a lot of low and middle-income countries, the effect basically disappears. It becomes statistically insignificant. So the big takeaway here is, it's not about how much money you get, it's all about what kind of money it is.
So not only is the upside of FDI often way overhyped, but the paper argues that the downsides are almost completely ignored. Turns out, attracting foreign capital isn't a risk-free game at all.
One of the biggest risks is this thing called Dutch disease. Here's how it plays out. A flood of foreign money comes into a country. That makes the local currency get stronger. Sounds good, right? Well, the problem is, it makes everything else the country produces, say manufactured goods or agricultural products, way more expensive for the rest of the world to buy. And in the long run, this can actually cripple other parts of the economy.
And here's another point that almost never gets mentioned in the public debate. Foreign investment is not a gift. It's an investment, and it expects a return. So while a bunch of capital might flow in to build a new factory, a steady stream of profits and dividends will flow out of the country forever.
And let's put some real numbers to this to see how big a deal it is. Take Brazil. Between 2018 and 2023, on average, over 40 times billion dollars flowed out of the country every single year as payments to foreign investors. That's more than 2% of its entire GDP just leaving. That is a massive structural drain on the economy.
So let's recap. If some investment is fake, some is risky, and the growth benefits are questionable, how are we supposed to think about all this?
Well, the paper doesn't just tear down the old ideas, it actually proposes a new way forward.
This table is really the strategic heart of the whole analysis. It says we need to stop thinking about investment as just one big lump of money and start putting it into categories. Is it beneficial, creating real jobs, transferring technology, paying taxes? Is it conditional, with some good and some bad? Or is it flat-out predatory, designed to just extract value, kill off local competition, and dodge taxes? This framework completely changes the conversation.
And that brings us to the most crucial point of all. The bottom line is this. Just trying to attract any and all investment, no questions asked, is not a real development strategy. The paper argues the policy has to be selective. It has to actively chase the good investment while putting up guardrails to filter out the bad stuff.
So this all leaves us with one final and I think pretty provocative question. This isn't about being for or against foreign investment. It's about being smart. Is the investment flowing into your country actually building its future, or does it just look good on a spreadsheet?
If you enjoy this kind of analysis that goes beyond the obvious headlines, make sure you follow the Macroeconomia channel. We're always working on new explainers like this to help make sense of the complex forces shaping our world.
And finally, just our standard disclaimer. This material is a compilation from third-party sources and it's for informational and educational purposes only. It is not an investment recommendation or financial advice of any kind. And as always, past performance is no guarantee of future results. Thanks for tuning in.